Look at silver prices on your screen right now and notice the calm illusion of stability around $78 per ounce. At the exact same moment, physical buyers in Tokyo are paying nearly $130 for immediate silver delivery. This is not a short-term glitch, logistical delay, or regional distortion within commodities markets. It represents a complete structural fracture between paper pricing systems and physical metal reality. One of America's most conservative financial institutions just issued a warning acknowledging this fracture openly. Bank of America published a silver forecast unlike anything seen in modern commodity market history. Instead of one target price, they released 3 radically different outcomes for silver in 2026. Their base scenario places silver near $65 per ounce under ideal paper market conditions. The bullish scenario projects silver reaching approximately $135 per ounce. The extreme scenario projects silver surging above $300 per ounce within the same time frame. When price forecasts span nearly 400%, they stop being predictions and become systemic warnings. Bank of America manages trillions of dollars and answers to regulators, shareholders, and institutional clients worldwide. They do not publish extreme scenarios without deep mathematical justification and historical precedent. Their analysis draws directly from periods when paper commodity markets lost credibility entirely. For decades, silver pricing relied on futures contracts traded in New York, setting global benchmarks. Physical buyers worldwide accepted those prices with small premiums, covering logistics and dealer margins. That system functioned only because delivery of physical metal was assumed always possible. That assumption collapsed instantly on January 1st, 2026 without gradual warning signs. China implemented export licensing rules that fundamentally restructured global refined silver availability. China refines approximately 4,000 tons of silver annually for global markets. This represents roughly 60 to 70% of all refined silver traded internationally. New licensing rules eliminated hundreds of mid-sized refiners from export eligibility overnight. Only 44 companies now hold authorization to export refined silver from China. This effectively locked the majority of global refined silver supply inside China permanently. The impact was immediate as physical premiums exploded across Asian and Middle Eastern markets. Shanghai premiums jumped from 1% to double-digit levels almost overnight. Japanese bullion markets recorded premiums reaching 60 to 80% above futures pricing. Physical transactions in Tokyo and Dubai began clearing near $130 per ounce. Such arbitrage opportunities should disappear instantly in healthy, functional markets. Their persistence proves delivery mechanisms behind paper pricing have broken catastrophically. The deeper problem lies inside futures exchange warehouse inventories backing these contracts. Registered silver inventory has collapsed more than 70% since 2020. Meanwhile, paper contract open interest remains near record levels across delivery months. January delivery demand alone approaches nearly 80% of available registered inventory. Functional commodity exchanges operate safely at 10 to 20% delivery utilization. Current utilization levels indicate severe stress and imminent delivery failure risk. Industrial buyers cannot wait months for settlement disputes or force majeure declarations. They pay whatever price secures immediate physical supply for ongoing production. This creates a two-tier market, separating paper quotations from real metal transactions. Silver leasing rates exposed the crisis when borrowing costs exploded dramatically. A single large physical order froze the London silver market entirely. Major refiners withdrew, citing inability to source metal at quoted prices. Such behavior mirrors historical paper market collapses driven by physical shortages. Bank of America used gold to silver ratios to calculate future outcomes. During 1980, physical delivery stress compressed the ratio dramatically. Today's ratio remains historically elevated, signaling extreme silver undervaluation. Physical scarcity now dictates price discovery, instead of futures speculation. Western exchanges cannot deliver promised silver at current or doubled prices. Industrial demand continues rising regardless of price volatility. Silver supply deficits have persisted for 5 consecutive years globally. Above-ground stockpiles are being depleted rapidly to meet demand. Solar manufacturing alone consumes hundreds of millions of ounces annually. Electric vehicles and advanced electronics add accelerating silver demand pressures. Artificial intelligence infrastructure introduces entirely new consumption requirements. Silver has no viable substitutes for its conductivity and reliability. Major banks have quietly shifted strategies toward physical silver ownership. JP Morgan recently stood for physical delivery instead of rolling contracts. Banks avoid physical settlement unless paper reliability is questioned. Taking delivery signals distrust in future contract settlements. January delivery activity shattered records for a traditionally minor month. Registered inventories continue declining as owners remove metal from delivery pools. Owners expect better pricing outside futures exchanges. Large institutional orders revealed how little silver is truly liquid. Most reported inventory is locked inside exchange-traded funds. China's export restrictions removed millions of ounces from global circulation. Asian nations now negotiate directly with Chinese exchanges for supply. Physical premiums reached 80% in multiple global hubs. Paper prices now exist primarily on trading screens. Real buyers prioritize availability over theoretical spot prices. Bank of America concluded current paper pricing is unsustainable. Their targets reflect inevitable repricing driven by scarcity. This timeline unfolds in months, not decades. Margin hikes signal growing stress inside clearing systems. Industrial buyers increasingly bypass futures markets entirely. Hoarding behavior accelerates supply exhaustion. Paper leverage exceeds hundreds of ounces per physical ounce. Even modest delivery demands could collapse exchanges. Banking sector losses could reach tens of billions. Emergency liquidity injections hint at hidden institutional stress. Mine supply cannot expand quickly due to byproduct constraints. Demand growth continues outpacing production with no relief. Prices must rise enough to destroy marginal consumption. Engineering substitutions require years to implement. Until then, buyers pay any price necessary. This drives the extreme scenarios Bank of America outlined. The current price cannot reflect physical reality. Smart money already pays massive premiums without hesitation. Availability matters more than quoted spot prices now. Physical silver may disappear regardless of price. Bank of America delivered the warning. Markets will deliver the outcome.